But the third thing I'm going to notice is that the venture building ecosystem is a lot weaker than it is today. And one of the big parts, one of the big reasons why, is that there is no venture capital industry pretty much to be seen in Europe at all, and even globally. The venture capital industry starts coming around in about the 1950s, 1960s. That's when it really starts to gain force. Today, if we fast forward, we're going to see venture capital becoming a more and more important force in the ecosystem that allows so many of the incredible companies you're meeting today to rise up and start delivering. And I think the dramatic rise of venture capital is visible even in just the last 10 years. So let's go back 10 years ago and look at what venture capital was like in Europe. Again, venture capital is the capital source that is allowing a lot of these founders to do what they do. It provides the investments, and it allows these people to hire and build teams that they couldn't otherwise build. So 10 years ago, how much venture capital was there in Europe? The answer is that there was around 3.5 billion euros worth of venture capital coming in, and it accounted for about 8% of what we call private equity capital, which is capital going into companies that are not traded on the stock market. So today, if we look at 10 years later, we can see that the venture capital industry has at least doubled in its importance, both relatively for investors and also just in aggregate about the amount of money that is being deployed here. So today, of course, we have around 11 billion being used in European venture capital investments, and we have almost 16% of the total capital allocation shifting in this direction. So venture is becoming more important. It's becoming a more important force in the world of business finance. And this is a testament not just to the incredible innovative founders that you see here today in the Lighthouse program, and that are really in so many places when we look around in the Lighthouse community, in our fintech hub partners, in a lot of the ecosystems that we're supporting. Those ecosystems are, of course, one of the reasons why we're here today. And the Lighthouse is a great example of an ecosystem that is able to support these founders. So if we look at the Lighthouse company and we see what venture capital interest they have, we see that the interest is pretty high, actually. Lighthouse companies come in, and almost all of them have raised venture capital. The average company has raised 1.2 million euros in capital before coming in to the Lighthouse program 3 years into their existence. If we look at how much capital these companies have raised total, both before, during, and after the Lighthouse program, that total is closer to 150 million. And I must say, we were overwhelmed just a month ago when we hosted our first ever Lighthouse Investor Demo Day, and we saw an incredible outpouring of interest from the dozens and dozens of investors that want us and our community to grow and succeed. And it's a really exciting testament. The thing about venture capital, lots of people want to talk about it. You saw Suzanne say that this is one of the most important problems that founders talk about and face. And I think a lot has been written about raising VC, but less is written about the, honestly, a lot harder problem of what do we do once we've received a VC investment? How do we pay our investors back? Because of course, the reason that this industry is growing is because these investors expect to see returns. And that's where I want to take us to the second graph here on the slide, which talks about the exit plan. If you're a founder that's lucky enough to raise funds, your investors will eventually want to know what is your exit plan. And I guess it's important to just kind of look at the data and see where statistically speaking, will I be in a few years. Here we're in the Lighthouse program. We work with a lot of banks, and you might think, I'll sell to a bank. That is very possible, and as you see here, it's significant enough to get its own look in the data when we are able to study these sorts of transactions across the European continent. That said, it's not the most common way, and we can go into some of the other more common options. The second most common way, the second least common way rather, is the initial public offering. And we had our first IPO within the Lighthouse company group this year when ZignSec IPO'd. And that, of course, is where it gets a lot of media attention. So you might have heard recently that Robinhood is trying to IPO itself. Of course, that's a very dramatic way where you go and list your company on the stock exchange. It's not that common either, as we can see here. It's actually less common even than the third option, which I don't hear founders talking about a lot, but in fact, it's one of the most common ways that you can exit your VCs, and that's for you to actually buy stock back from them. That is the management buyout, and it's, of course, the third most common exit path for founders. The fourth, and I think this is where we really want to spend the time in this session, and also you can read more about it in the white paper that we'll be releasing soon, is the trade sale, or basically selling your company to another company in the same industry. So not a bank, but another either big industry player like a MasterCard, for example, or another startup. And that is the interesting trend that I want to lock in on. Because if we look at the Lighthouse data set, just this year, we've had 5 Lighthouse companies that we know of engage in sales, and multiple instances of that were to other startups.